Risk management is so underrated. I'm a certified risk management fanboy. Trading channels always talk about how to find more trade entries, blah, 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 but hardly anyone focuses on risk management. People think it's boring, it's the unsexy part of trading, it doesn't get views. People are wrong. Yes, it's all about the losing side of trades and people only want to hear about the profits, but guess what? If you want consistently bigger and better returns from your trading, that's easier to achieve by reducing your losses. So it's time to get creative with your risk management. When you're entering a trade, you should be assessing the situation and then strategize the best risk management approach to maximize that opportunity. It shouldn't just be an afterthought, thinking, okay, where should I put my stop loss? What position size? You need to go beyond basic risk management that everyone else does. Build a toolkit of different approaches that you can chop and change to find the right risk strategy for that specific situation. So to get you started, here are a few essential tools that you can use to get more creative with how you think about your risk management. Sometimes an opportunity will look great, except for one particular factor that's causing extra uncertainty that might disrupt the trade. Okay, there's one thing that you're like, oh, that thing might disrupt the trade at this point of entry. For example, significant levels will often attract the price. The price will move to those significant levels. So if there's a major significant level near your potential entry point and that significant level is untouched, there's a risk that the price may need to move and engage that point first. But if the price does respond to the setup that you found and it moves away from that level that's causing the uncertainty is gone. So one way or another, the next price movement is critical. Now, if I enter my trade, the price may then head towards that level and I'll be in a loss. But if I don't enter my trade because I'm anticipating that may happen, it may then respond to the setup that I didn't take and I miss my opportunity. So in those situations where I might enter the trade and end up in a loss, or I might not enter the trade and not end up getting the opportunity, I use a probe trade. This is like the best of both worlds. So I first decide what percentage I'd risk on the opportunity if that additional uncertainty wasn't there. And let's say, for example, that I think it needs 0.8% at risk. I'll then decide how much that particular factor affects my confidence to enter the trade. And I'll then reduce my position size based on that. Like I might make it 0.5% at risk instead. So it's 0.5% at risk for the probe trade and 0.8% for the full trade. Now, there's a difference to situations where I feel a setup or an opportunity is one that just needs 0.5% at risk, because in probe trade situations, I'll scale up to the entire trade of 0.8% once that uncertainty is gone, whether that's from the price moving and interacting with that level or the price moving away from it so it's no longer a factor. Now, this is the only time that I ever scale into losing positions, because I'm already deciding upfront at the point of entry how much I'm willing to risk, and then I'm actually scaling that back. Now, this differs from traders who react to their losing trades by increasing their position size, trying to improve their average entry price. That's more to do with, loss aversion and wanting to claw back the bit they've lost and get into profit sooner. They're increasing risk in a losing situation. Whereas with a probe trade, I'm actually taking away from the initial risk right at the start and just adding it back in when the opportunity deserves it. It's also different to regular scaling in, because in those cases, you're increasing your position size because something has fundamentally changed about the situation. Either you've moved your stop loss up into profit, so you have less at risk and you want to adjust the position size, or the situation has become less risky because the context has changed. But the beautiful thing about a probe trade is that it isn't about increasing risk, it's actually about reducing the risk and then putting it back. I think of my stop losses as two things, a hard and a soft stop loss. A hard stop loss is just a standard stop loss. It's the one I place with my broker, so I'm automatically taken out of the trade when the price reaches a particular level. But usually my soft stop loss is much more important than the hard stop, because this is where I'll exit the trade manually based on specific criteria that a hard stop wouldn't be able to execute based on. So for example, a hard stop would close the trade when the price hits a particular price level. But what if the price doesn't end up closing through that level, but fails there instead? That could be a turning point. For the Duomo method, that's a type 1, 2, or 3 close. So my soft stop instead will be based on the price closing through that level. If the price closes through that level, I'll exit the trade manually. But if it just touches that level, I'm not closed out of the trade. Instead, my hard stop loss will be just beyond the point where if the price reached that point, the probability of it returning to the other side of the level and failing is too low. The probability is too low. So at that point, it's better to take the loss and be out of the trade rather than risk the loss getting any bigger. Okay, so soft stop is at the point where, if the price touches it, I won't be out of the trade. If it closes through it, I'm out of the trade. Hard stop is at the point where if the price reaches that, there's very low probability it gets back above the level. This means I can reduce the number of times that I'm stopped out of my trade, only to then see the price fly off in the opposite direction. We've all been there. But because I'm not being stopped out at the significant levels, that's not going to happen so often. And also that means that this tool is great for anyone who's worried about things like stop hunters and that kind of thing, which I'm not, to be honest. You could have a hard stop further away from the price level, just in case some disaster occurs. Then that hard stop can be a backstop to protect your capital, but your soft stop isn't visible in the market. The last tool I want to share with you is to use scaling out not only as a way to bank partial profits, but also as a risk management strategy. You see, when the price has moved into profit, many traders adjust their stop loss to break even. But so many traders complain about being stopped out too early when they do this. And it makes sense because you've most likely entered your trade at a significant level, so there's a reasonable likelihood of the price retesting it, even if it's going to continue moving in your favor. So if you've moved your stop loss to break even, it will be right on that significant level and close you out of your trade just based on a passive retest. Instead, scale out as a way to de-risk the trade without having to move your stop loss. When the trade is in profit and hitting a path of resistance, so there's a chance it might reverse from there, you can bank just enough profit to cover the loss that you take on the remaining amount of the position if you keep your stop loss in its original place. So for example, if the price has moved as much from your entry into profit as your stop loss is from your entry, you'd need to exit 50% of the profit to cover the stop loss. So let's say, for example, your stop loss is 10 pips away from entry. If the price is now 10 pips in profit, 50% of the position closed covers the stop loss. A bit further, and it might drop to only needing 30%, 20%, 10%, and so on. Taking this approach will obviously reduce the potential profit you could make since you're closing part of the position. So just like all of the tools that I've explained, these aren't things that you want to do with every single trade, only when the time is right. So some trades, it might be better for you to just move your stop loss to break even and keep the whole trade open. Some trades, it's better to just leave it all as it is and not take any action. But for me, the market conditions that are most suitable for this approach are times when there's a lot of volatility and the price is whipsawing quite a lot. Because you're most vulnerable in the markets when you have a trade open, because that's when you're exposed to market risk. So if the price is particularly volatile, you won't want to stay exposed for longer than necessary. However, if the price is volatile, then there's a higher chance of it hitting your stop loss if you move it to break even. Therefore, in those situations, scaling out part of the trade to de-risk the whole position is the right thing to do. When we talk about de-risking, we're talking about if the stop loss is executed, you're neutral, you haven't lost any money. Now, if the market isn't riskier than usual, it isn't more volatile than it normally is, you're in steady state markets, but you know at the point of entry that you are going to be de-risking in this way, you could enter the trade with a slightly higher position size than usual because you know you'll be de-risking it soon after and you'll only have that additional risk exposure for a relatively short amount of time. Now remember, these tools aren't things that you should be using on every trade. There are many other things you could be doing as well, like trailing your stop loss, scaling in and out, etc. But what I want you to think more about is how you adjust your risk management strategy to match the opportunity. Get more creative with it, strategize, don't just keep things basic. Now, I'd recommend hopping into a trading simulator and challenge yourself to think more strategically about your risk management in some situations that you've experienced before. So use the trading simulator to go back to previous trades, approach them differently, test these things out. And in the description box down below, you'll find a link to our resources page for my recommended trading simulator. And also down there, you'll find a link to sign up for our mailing list so I can send you my trade breakdowns each week, along with many other helpful things. So check that out. Thanks for watching. I'll see you in the next one. Take care, guys.